Great. Good morning, everybody. We'll call to order the Retirement Plan Subcommittee meeting this Tuesday, May 2nd. It's now 8 o'clock, and looks like we have a fairly usual agenda here, with the review of minutes, and then we'll kick it over to Chris for his review. But so first, why don't we go over the minutes? Does anybody have any questions or comments on the minutes that were in the packet? Okay, so I'll take a motion to submit the minutes as drafted.
Move that.
Do I hear a second?
Well, I would second, but I'm also going to be, I guess I will second that motion, but then I need to abstain because I was sick.
Oh,
So,
I got you. So all in favor of submitting minutes as drafted, say aye, please.
Aye.
Aye. All right, great.
and then I will abstain since I was
And
out.
one abstention. Okay, thanks, Amber.
Sure.
So next on the list, next on our agenda, I should say, is a communication from our town attorney, Bob DiCrescenzo, a legal opinion on DEI and ESG investments. This is a conversation that we've had, I think, for the last couple meetings now. I know this was something that Amber had kind of started asking about, and it really got to the point where it made sense for the Board of Finance to understand what our fiduciary responsibility was regarding ESG and DEI. And so we got that, and that's in your packets. I would say it's a little less of an opinion as it is a recommendation, as outlines that, we have to follow the prudent investor rule, both from the town charter, what our, charge is as the Board of Finance, but then what we're also legally obligated to do by the state. So we all have the letter. If there are any questions, I think, it's a little unique, and correct me if I'm wrong, Chris, but we don't have any direct investments. So if we really wanted to dig in and ask the questions of our investment advisor, which was the recommendation of our town attorney, that we'd really have to, to really get a good idea, we would really have to dig into the underlying investments of the funds that we were in. And like I said, I think that there could be questions, but we would, always defer to our investment advisor. So anybody have any thoughts? I'll open it up for discussion as to, in terms of what our town attorney had discussed. And if we think there are any follow-ups, I can make sure that gets put back to the Board of Finance for follow-up.
I might just offer up, Derek, to the group as a reminder for folks. I think people will remember this. Remember, not too long ago, we had run your rosters through our ESG DEI framework, right? So we do have an analytical framework that queries on some of the things that people are talking about in terms of the way that your managers are attending to those type of issues and addressing them. And you'll remember that by and large, and certainly not in each and every data point, but by and large, your managers were thinking about those issues as they're building their portfolios, right? And when you talk to our research teams, they will tell you now that when they're talking to your managers, almost without fail, they are all in some form or fashion considering, and I'm using the term broadly, obviously, good citizenship factors when they're building their portfolios. And are mindful of those things, right? And so I think that there is, in a derivative sense, I don't want to say adherence to, but an acknowledgement of these type of issues for the majority of your managers in your programs. And then the other thing is a reminder, as you know, because it's the more pointed query and the fair one, What are we seeing in the marketplace in terms of explicit adoption of these type of mandates in fiduciary settings? And quite bluntly, across our municipal practice, there's not a lot of it. Really, there's none of it. Folks are talking about it. They're aware of it. They're relying on the industry, if you will, to begin, continue to advance those conversations and analytics, but they're not explicitly going out and putting capital into ESG managers, screened managers, or other type of managers. We just have not seen that movement, although, as I mentioned, there's been lots of conversation. The closest we got, just as a real world example for the committee, the city of Burlington, Vermont, is a client. The city of Burlington has some very strict guidelines around fossil fuels and other things, and they pushed the retirement committee on some of those issues, and the retirement committee ultimately decided that they were not comfortable in their role as fiduciaries, putting third-party capital, participants' capital into those type of strategies. They just didn't feel it was in their wherewithal and not something that was appropriate. So despite being, strongly urged to do that, they decided ultimately not to make those type of investments. So I think the way for us to handle it pragmatically going forward, right, is we'll continue to periodically run your portfolios through our screens and give you those assurances that I mentioned earlier, that there's an awareness of these type of issues when your managers are investing, and certainly revisit the conversation and the topic at the behest of the committee. But I'm not sure there's an action item, Derek, right, or a recommendation or a call to invest in screened investments right now, at least as I understand it.
Yeah, and I don't think that's what we're asking. I think if, as we go through our quarterly discussions, if there's specific questions that, we have about a certain investment, and maybe even a deeper dive if necessary, that can be reported back on, I think that's really what the nature of our town attorney's response. I would say that, I think, you used oil companies as an example. I mean, it's safe to say that, that they're subject to the same types of, if not more prudent, I guess, vigilance in terms of their good citizenship, right? Because they know that it almost qualifies as like a sin stock, very similar to like certain state pension plans won't invest in, shopping centers, for example, that have liquor stores in them. So, so the obvious question then for me is, why is that? Why is it that, state or municipal boards, such as one in Burlington, Vermont, are deciding not to do that? Is it a matter of quantifying what the real returns are? And then, as a pension beneficiary, are you not looking for safety in your income streams as, a retiree, and making sure that you're maximizing your return on your investment? I mean, is that the impetus for those types of discussions? I would expect it to work almost backwards, where pension beneficiaries were saying, we want to invest in socially responsible stocks, as opposed to the cities and states mandating that. Do you have any thoughts on that?
Yeah, I think you hinted at it, Derek, right? I think the jury is still out quantitatively on what type of give up or trade-offs you may be making in terms of return potential, screened versus quote unquote non-screened. And again, that is becoming a very gray area, because as I mentioned, I think a lot of very competent, capable managers have started to incorporate those factors into their analytics. And I think over time, you see kind of those considerations morphing together a little bit, right? But I think given that as we sit here this morning, there's not a very definitive sand in the line in terms of the return potential screen versus non-screen, for lack of a better moniker, I guess. I think most folks who sit in your seats as fiduciaries are inclined to, go with what's familiar, right? We our quote unquote unscreened investments are diversified. They're fulfilling the needs and objectives of the plan. We're not taking stuff away from the return potential framework, if you will. And they've just kind of defaulted to that being the approach now and letting the industry, again, kind of catch up on these type of things, right? And maybe not being a first mover on some of it. So we just haven't seen a lot of actual take for this type of thing across our municipal book. But again, as I mentioned, I think we continue to see lots of conversation. And I think the onus is on us as your advisor, as you mentioned at the onset, to keep you apprised of developments here. And over time is invariably this issue will morph, and we'll bring that information and those ideas and perspectives to the committee, and it'll be a kind of a working topic that we'll revisit on a fairly regular basis, I would think.
Amber.
Yeah, just to be clear about this, since I think that we kind of dived into this topic based on some of the concerns I raised at a prior meeting. I mean, I was not advocating that we are taking an active approach to change our investments and invest in ESG screen funds. But I think it is a fair question to say, when we are looking at a menu of options, any of which a prudent investor might pick, to what extent are we allowed to consider ESG factors as a relevant factor in that discussion? And I think this is an evolving issue. There's been a lot of guidance that have come out about that. And I think it's something that we do need to keep on our radar screen and think about, because I think that there is a difference between saying we're actively taking on this management and saying we may have choices of which, multiple items would be reasonable, but can we consider those factors as a tiebreaker or something? So I just kind of want to put that clarification on there, because I don't think anyone was suggesting that we were making any kind of radical change to an active ESG managed portfolio.
Yeah, those are great perspectives, Amber, right? And I think to your point is spot on, right? So and I think there is an element of tiebreaker activity, right? As I mentioned earlier, because I think a lot of the managers out there that you use, which are world-class managers, are having these conversations internally on your behalf, and where the math makes sense, right? They'll maybe select a company, all else equal, that demonstrates those characteristics versus one that does not. So I do think there's a bit of movement there under the hood, if you will. And then just before I forget, Derek, you brought up an interesting point, and Paige would probably punctuate this and speak to it more eloquently than I. Where you do see some take is in DC arenas, right? Where you've got participants clamoring up and saying, we would like an ESG option. Just to your point, right? It's coming directionally from the participants, not being imposed from a committee in the other direction, right? And you have seen a little bit of that in the marketplace, where you'll add a fund or two, if you will, at the behest of participants. So that's kind of an interesting point you bring up, and something we actually see in the marketplace, if you will, in terms of the way companies or plan sponsors are responding.
Yeah, I totally agree. And then also there's increased interest in ESG, especially in the higher ed space, but very low utilization that we're finding as when we take the surveys. So definitely an interesting concept and growing each year.
Yeah, I think time will tell, Chris, as you mentioned. I think over our 3, 5, and 10-year horizons, when we're having this conversation 3 years from now, 5 years from now, we're going to see that kind of morph into investments more and more. The drumbeat is there; it's not going away, and I think that we're on the road to more quantifiable results. So I think that's a really good thing. I just ask, if anybody else has any other questions or thoughts on this topic. It's a great discussion. And if not, that's great. We can turn it over to Chris and his team to continue on with the pension plan and OPEB trust review, and then on to the defined contribution plans after that. So I'll turn it over to you, Chris.
Great. Thanks again. And good morning, folks. Good to see everyone. You notice Paige Thompson joins me today, a colleague who specializes in defined contribution plans. And I don't know where I don't know where Tyler is today, but he's off doing something and sends his regrets. And the page is certainly up to the task to catch up on the DC plan. But with that, let's give me 2 seconds here. Let folks know when you can see my screen.
Yep.
Looks good.
Bear with me here. I'm just gonna clean it up there, okay? And we'll jump ahead here and kind of work through, select slides to catch up on the relevant stuff and get you on your way. Just quickly, from a housekeeping perspective, the very first couple of pages in the slide deck that Kelsey had forwarded to the committee to just highlight some of the research and work that's going on a recurring basis. So to the extent members of the committee have an interest in what we're thinking and what's going on in markets and kind of other things across different client groups, if you will, there's lots of collateral on the website, and we would encourage you to go out there and visit it. And obviously, if you've got questions, reach out to Tyler or I. Our conference is in Boston, the end of September. You see that. We'll continue to remind you. You're certainly all invited. Would love to have folks up there. It's typically a pretty productive day and a half. And I think we get close to 200, 250 clients there each year. So well attended and I think worthwhile. And then finally, we do continue, you see here on the bottom of page 3, to hire, right? We obviously have designs on growing thoughtfully, but certainly in a manner that doesn't compromise the services that we render to longstanding clients like the town of Simsbury, but we are hiring folks and continue to have plans to grow out the framework as we thoughtfully grow the practice. And these are hires across Chicago, across Windsor, and in some of our other offices as well. So with that, just quickly catching you up on kind of markets in the quarter. And as we'll see momentarily, it was actually a pretty constructive environment for investing, all things considered, in the first quarter. We had begun the year, for those of you who remember the February meeting and then some of our year-end collateral, with this idea that we expected volatility to remain pressed higher for the foreseeable future. And really the takeaway on this page hopefully illuminates some of the reasons why we expected volatility to remain elevated, right? The Fed has obviously done a lot of work on the rate front. We think they're much farther along in their campaign than not. So perhaps on the margin, volatility begins to settle down, but the jury is still out. And you see that in the upper right-hand corner of the page there. So the data points themselves aren't as important as you see kind of just the volatility of expectation around where Fed fund rates might be at the end of the year is pretty striking. So you see there over a couple of different recent timeframes, the way that those expectations have been bouncing around, and investors really continue to grasp with, right, where that terminal rate is and where this campaign ultimately ends. And that uncertainty has certainly been a source of volatility. And the motivation for that, as well as, has been to try to get inflation under control, front and center. And you see in the lower left-hand corner, that same page there, just some of those longer dated CPI prints starting to roll over and moderate a little bit, which obviously is front and center for the Fed in terms of objectives. And again, the jury's still out there, right? We're not all the way along. We've had other sources of volatility, be it the banking crisis, be it the situation in Europe with the war, or the Credit Suisse UBS situation. There's just a host of things that have been pressing on markets and investor anxiety. And again, probably something that for the next several months anyways, we'll continue to see a bit more of. The committee's always been great, as you know, through time of being kind of very disciplined and patient, I think, with your strategic allocations. No surprise to this group. We thought it was an interesting data point nonetheless. On the graphic in the lower right-hand corner of the page, you'll see there, just since the onset of the pandemic, a host of or a mix of different kind of allocation constructs, and right, as you would expect, for those that have had the wherewithal to stay invested and allocated, you've generally been pretty well rewarded to do that, and that's, as you all know, from a historical standpoint, a pretty consistent outcome of trying to avoid making what are perhaps rash decisions in the immediacy of a market stress. And again, this group has never fallen victim to that, to your credit. A little bit more in the way of larger economic data here. An interesting point, the other thing that has been talked about is we've had an inverted yield curve for quite some time, as you all know. Historically, that's associated with recessions. And that is certainly another factor that's weighed on investor psyche a little bit here over the last couple of quarters for sure. Consumers, upper left-hand corner of page 7 here, are 70% of economic activity in the U.S. And the consumer, all things considered, remains in pretty solid shape. The job market is in pretty solid shape, and that is informing this view that you're seeing that if in fact we do get a recession, all things considered, it might be a fairly mild one. So, I think that is, as we'll see in a minute when we look at returns, been another factor that is kind of helped navigate us through this first quarter, this first part of the year that's been a pretty productive one in markets. Maybe the last point of interest here to the committee, because I know we've talked about international equity investing on regular occasions in the past. You all remember that the dollar had been extraordinarily strong for an extended period of time, and that had certainly been a headwind for international equity investing. And the dollar has started to roll over a bit. You see that in the graphic in the lower left-hand corner of the page. As the Fed campaign matures, as the economy maybe on the margin is not quite as strong as it was, those things have kind of driven the relationship between U.S. interest rates and international rates is not as pronounced as it once was, and you have started to see the dollar soften a bit. And as we'll see in a minute, that's actually meant good things for international equity investing, and probably on a go-forward basis could be a tailwind as well. So cutting to the chase here, just quickly, the top half of the page, you'll see returns for the first quarter, the year-to-date numbers, and kind of the almost the exact opposite of, you'll remember what we were looking at last year when we had the kind of the universal drawdowns in markets. We had a nice recovery and a fairly broad one as well for fixed income on the left-hand side of the graphics there, with interest rates coming down a little bit. And credit spreads pretty well behaved. We had a nice 3% return for the broad fixed income markets. And you do see there in the gray graphics on the right-hand side of the page there, global equity returns. And as I mentioned earlier, interestingly enough, right, developed markets overseas being the very best performers in the quarter, up 8.5%, but good returns elsewhere. In the equity markets, right, both here in the U.S. and even to an extent in the emerging markets. So the markets did have a pretty productive Q1. Let me pause there for just a minute, big picture, and see if there's any questions from the committee before we delve into some of the portfolio details. And just again, stop.
Chris, I did have a quick question. Sorry, I put myself on mute. So a couple things, not that they can't be, that they can't coexist, but it's been reported that the savings rate eclipsed, I think, $1 trillion across the U.S., which was actually surprising to me. I thought a lot of the stimulus had attributed to that and was paring down. At the same time, credit card debt is eclipsed $1 trillion as well. So again, not that they can't exist, but together. But why? What's the takeaway there from increased borrow the strength of the consumer as consumers continue to borrow more?
Yeah, it's like you said, I think, Derek, the metrics are a little bit mixed in terms of the prospects for the consumer, but The indebtedness numbers you mentioned has moved a touch higher on the credit card front, but core savings remains pretty stable. I think, and I'm not sure I've got a definitive answer for you on that disconnect. What I would offer up, though, the other backdrop is kind of indicated here, and we think is maybe as an important factor in terms of the fate of the consumer, and what continues to press extraordinarily in a resilient manner is the labor market itself, right?